In this video, I will discuss my top 3 favorite index funds and ETFs in Australia and why I think most people should just stick to these ones in particular. I will also explain what is an index fund and why Warren Buffett himself recommends them for most people. By the end of the video, you'll have a clear understanding of what index funds are and why they are so powerful in creating passive income and long-term wealth. I would encourage you to watch all the way through because it may just change the way you think about investing. So if that sounds good, let's roll the intro. What is going on, future millionaires? Welcome back to my channel. It's your boy Brian bringing you another straight up educational video. If you're new to the channel, my name is Brian. I'm an investor from Australia who loves to talk about personal finance and investing. My motto is, if it can make us money, then I'm going to talk about it. So if you haven't already, click that subscribe button and the notification bell so you don't miss any of my future content, which is aimed at helping you create a long-term portfolio the right way. Alright, so let's get straight into today's topic, and today we are talking about index funds and ETFs. Now, you may have heard these terms being thrown around, maybe at work, by the water cooler, or with friends at a party. The two are kind of the same things, but different. An index fund is typically a low-cost, low-risk investment portfolio of shares that tracks the components of a financial market index like the S&P 500, which tracks the top 500 US companies. An index fund allows you to invest in a basket of companies all under one stock. They are very popular because they maximize diversification and reduce risk. In fact, Warren Buffett himself has recommended most people to invest in index funds because it makes more sense for the average investor to buy all of the S&P 500 companies at a low cost than to try and pick out individual stocks. Now that you know what an index fund is, what about an ETF? ETF stands for Exchange Traded Fund and is a type of security that tracks an index, sector, or other assets. When most people mention ETFs, they are generally talking about an index fund, as that is the easiest way for a person to buy an index fund. So essentially, an ETF mimics an index fund. To find out if index funds are a good fit for you, you must first ask yourself, what kind of investor are you? Usually there are two types of investors, active investors and passive investors. An active investor is someone who is willing to put time and energy into researching stocks and try to outperform the market. A passive investor, on the other hand, wants to use the least amount of energy to research and is happy to accept the performance of the general market, therefore they prefer to invest in index funds. I'm a bit of both, with half my portfolio in index funds for the long term and the other half in individual stocks amongst other assets like crypto, which I'll make a future video about. But back to index funds, and here's the crazy part. There have been several research done in the past which concluded that the majority of professional active investors, aka the big mutual funds that are paid to invest other people's money, fail to beat the market in the long term. Therefore, funny enough, the strategy with the least amount of effort required is statistically the better strategy. And that is why I agree with Warren Buffett when he says most people should just stick to an index fund. And now I'll talk about my 3 favorite index funds or ETFs by Vanguard and why I think they are suitable for most Australians. Of course, please note I am not a financial advisor and the comments I make today are for entertainment purposes only. So you should just use the information I provide as a guide to do your own research if you are interested in investing. The first ETF on my list is VAS, which is the Vanguard Australian Shares Index ETF. This is Australia's most popular ETF for tracking the Australian market, and for good reason. This ETF tracks the top 300 companies on the ASX, including Commonwealth, BHP and Woolworths. It charges the low management fee of 0.1%, which works out to be $1 for every $1,000 invested, which honestly is peanuts when you look at the bigger picture. The thing I like about this ETF more than other ASX ETFs is that it tracks the top 300 companies instead of top 200 like most others, which adds another 100 smaller cap shares. This increases diversification while reducing the heavy concentration towards ASX banks and miners, which the ASX is generally famous for. This ETF generally pays out dividends 4 times a year, and since it is domiciled in Australia, you can choose to automatically reinvest dividends, which saves you brokerage fees and time. Not all Vanguard ETFs allow automatic dividend reinvestment, which I will discuss later on. In terms of performance, it has averaged about 11% in the last 5 years and about 10% since its inception in 2009. Please note that these figures assume you reinvest your dividends. I would strongly recommend you reinvest your dividends because that will help you compound your wealth faster. The performance is about the same as what the S&P 500 returns in the long term, and I believe if you stay disciplined and continue to dollar cost average into this fund, then you'll grow your wealth significantly in the long term. It should be noted that this ETF is made up of dividend heavy companies like our big Australian banks, miners and supermarkets, which could be a good thing if you're a dividend investor and like having extra income hit your bank account several times a year. However, please note you have to pay tax on these dividends whether you reinvest them or not. So please keep these things in mind if you decide to invest in VAS. The next ETF on my list is VGS, which is the Vanguard International Shares ETF, which tracks the entire global stock market, excluding Australia. It's called International Shares ETF, but it's more like the US plus the rest of the world because the US makes up 70% of the weighting, with the next 5 highest countries from Japan, UK, Canada, and France. It holds 1,500 of the world's best companies, including Apple, Amazon, Google, and Nestle. Even though it tracks the global stock market, it is still domiciled in Australia, which allows for you to automatically reinvest your dividends. The management fee is 0.18%, which is a little bit high, but it's not that bad. You are paying $1.80 for every $1,000 invested. I'm more than happy to pay this given how diversified this is. In terms of performance, VGS has returned about 15% in the last 5 years and about 14% since inception in 2014. This is mainly due to the rise and growth of big tech in the US in the last decade. Since this ETF excludes Australia, if you combine VGS with VAS, then you can essentially track the entire global market. Like I mentioned before, both these ETFs are domiciled in Australia, which means you can auto reinvest the dividends, which makes it even more passive by nature. In fact, the VAS and VGS combo is very popular in the FIRE community because you are able to automatically reinvest your dividends and create both growth and income in a truly passive way. And I couldn't agree more with them. This is the combo I would recommend for most beginners, especially if you are young and have decades upon decades to compound your wealth. The dividends are also not as high because it is heavily weighted to the US market, which in general is more high growth. So share price appreciation is the way this ETF will grow rather than reinvesting of dividends like with VAS. Just consistently dollar cost average into these two ETFs and you will outperform the majority of professional active investors. The third ETF is VDHG, which is the Vanguard Diversified High Growth Index ETF. And this ETF is as diversified as you can get. This is because it is basically an ETF of Vanguard ETFs, because it contains 36% VAS, 42.4% VGS, 7% bonds, 6.4% VISM, which tracks the Global Small Cap Index, 5.1% of VGE, which tracks emerging markets, especially in Asia, and 3% fixed interest. The management fee is 0.27%, which isn't the cheapest, but for the sheer convenience of having one ETF track everything, it's probably worth the fee. This ETF was only introduced in 2017, so it is still relatively new. Nevertheless, it has returned about 11% in the last 3 years, which makes sense since it's heavily weighted between VAS and VGS. This ETF is also very popular with the FIRE movement and the Australian finance community. If I was ever forced to buy just one ETF, then this one will probably be it. If you don't want the headache of having to track 2 ETFs and rebalance, then VDHG would be a great option for you. It's the type of stock that you just buy and continue buying, then live off the dividends a few decades later. The reason I don't personally own this ETF is their 10% exposure to bonds and fixed interest. I feel like bonds and fixed interest is better suited if you already have a large portfolio or close to retirement and looking for a bit of capital preservation. I like my ETFs to be a bit more aggressive while I'm relatively young. Plus, I like having the ability to rebalance if I am more or less bullish about Australia or the US. You can't do that with VDHG because the weighting will always be about the same. Nevertheless, if you do your own research and decide on this ETF, then it is a great choice. I now want to talk about another popular ETF from Vanguard that didn't make my list. And that ETF is VTS, which tracks the entire US market. The reason VTS didn't make my top 3 is because it has a few minor inconveniences for Australian investors, compared to similar ETFs that provide similar things. Number 1 is domiciled in the US, which means it's more complicated to work out the tax. Number 2, since it is domiciled in the US, it means unlike the ETFs I previously mentioned, you cannot set it to auto reinvest, which to me is a pain because then you are forced to take the dividend in your bank account and will have to pay additional brokerage to reinvest. Number 3, you have to fill in the W8 BEN form every 3 years, which isn't the end of the world, but it just adds another thing to the list and moves the stock further away from the word passive. However, this is just me being picky, and VTS is a great stock if you already own it. But my thinking is, why settle for these inconveniences when there are other options out there that provide similar things? If you would like to buy an ETF that purely tracks the US, then I would suggest looking into IVV, which tracks the famous S&P 500. This is not a Vanguard ETF, but rather from BlackRock, who has structured this ETF in a way that you can reinvest dividends and not have to fill out the W8 BEN form. In addition, although studies have shown that S&P 500 performs very similar to the entire US market over the long term, I still prefer the S&P 500 out of the two, and this is literally the fund that Warren Buffett is recommending for most people. Another ETF I want to mention, which is actually my favorite, is the Nasdaq 100 ETF by Beta Shares that tracks the top 100 tech companies in the US. These include companies like Google, Facebook, and Tesla. Although big tech has run up high the last 18 months, I can't see it slowing down for the next decade. It will eventually pull back, but there are so many quality companies in there that as a tech nerd, it gets me excited just looking at it. I feel like this whole situation in the last 18 months has accelerated the acceptance and growth of tech. Now it's worth noting that if you have VGS, VDHG or IVV, that a lot of the big tech companies like your Apple, Google, Facebook, Amazon, Microsoft already make up a large chunk of the ETF. So there are some overlapping with the Nasdaq 100. I view the Nasdaq 100 as a higher risk, higher reward stock which focuses on tech, which historically trades on a much higher multiples, meaning the market expects their company performance to match their higher premium on their share price valuation. This is why I didn't include it as one of the top 3. In addition, the management fee is a bit higher at 0.48%, which is a little bit high. Again, I see the Nasdaq 100 as a higher risk, higher reward ETF, and if you're still relatively young and want a more aggressive ETF, then this could be a great option. It is also Australian domiciled, so you can auto reinvest the dividends. Personally, I own VAS, VGS and Nasdaq 100 because I want a bit more exposure into tech. But again, please keep in mind that tech is currently trading at a very high valuation. If you are interested in this Nasdaq 100 ETF, I would suggest using Comsec Pocket app to buy, as it's one of the 7 ETFs listed on their platform and they charge a cheap $2 brokerage per trade up to $1,000. And because you stayed this far into the video, I'm going to show you a bonus tip on how to reinvest your dividends automatically. It's actually pretty simple. You just have to register to their shared registry after buying their stock. You can find this information by searching for your stock on the ASX site. For example, Vanguard uses computer shares for the share registry, so you can register there and set up your address, bank account and reinvestment plans. It's that simple. So to summarize everything, if you are a beginner to ETFs and want an idea of what to buy, I would recommend looking at either the VAS and VGS combo, or keep it simple and stick with VDHG. If you're interested in purely the US market, then I would recommend looking into IVV and the Nasdaq 100. Look, you don't have to make investing complicated. Creating long-term wealth is actually quite easy. The hard part is staying the course and being disciplined. So research these ETFs, and if you do decide to invest, then dollar cost average and stay consistent. It may sound simple, but if you stick to this consistently, then you will create long-term wealth. I hope this video helped you out, and please don't forget to like, comment and subscribe and turn on the notification button so you don't miss any future videos to come. I have so much more useful content planned and you don't want to miss them. So until next time, my name is Brian and I hope you make a lot of money.